Good morning, everyone, and thank you for joining us today. We're here to dive into the comprehensive audit of group financial statements, an essential process that ensures accuracy, compliance, and integrity in consolidated financial reporting. This presentation will take you through the key aspects and best practices involved in auditing these complex financial documents, helping us maintain transparency and trust in financial reporting. Let's get started. In this slide, we're looking at the core focus and purpose of the audit for group financial statements. First, the audit centers on verifying the accuracy and completeness of the consolidated financial information, making sure that everything is correctly combined and reported. The primary objective here is to ensure the consolidation process is reliable and that it fully complies with all relevant regulatory requirements. Finally, an essential part of this audit is validating that the financial data from all entities within the group come together to present a true and fair view of the overall financial position and performance of the group. This helps stakeholders trust the reported information and make informed decisions. The scope of the audit includes all entities that are part of the group consolidation, so no entity within that group is excluded from our review. We focus on the entire fiscal period under examination, ensuring that all financial data for that time frame is thoroughly assessed. Our procedures are specifically designed to address key aspects of the consolidation process, including the elimination of intercompany transactions and balances to avoid any duplication or misstatements. Additionally, we evaluate the financial reports prepared at the group level to confirm that they are complete, accurate, and comply with the relevant accounting frameworks. This comprehensive approach helps provide a clear and reliable picture of the group's financial position. Our group consists of a parent company along with several subsidiaries, all of which are combined when preparing our consolidated financial reports. Within this structure, we have both wholly owned and partially owned entities, and it's important to recognize how these different ownership levels impact consolidation. Grasping the overall composition and the relationships between these companies is crucial because it ensures we accurately combine the financial results. Finally, applying the consolidation principles correctly depends on a clear understanding of the group's organizational setup, which allows us to reflect a true and fair view of the group's financial position. Our audit approach begins with testing the consolidation processes in detail, ensuring that intercompany eliminations are accurately performed. Next, we reconcile the financial data from each individual entity to confirm accuracy and consistency. Then, we examine all consolidation adjustments carefully, validating that the reported figures are consistent and reliable. Finally, we verify compliance with relevant accounting standards by conducting substantive testing and thorough analytical reviews. This systematic process helps us maintain confidence in consolidated financial statements. When assessing the consolidation process, our primary focus is on accuracy, especially when it comes to eliminating intercompany transactions and balances. This step is crucial to avoid any double counting or misstatements in the group's financials. Additionally, we carefully audit all consolidation adjustments to make sure they are appropriate and that the group-level financial data truly represent the combined operations of all entities. Verification is another critical part of the process, helping us confirm that the consolidated information is accurate and reliable. Lastly, we place great importance on ensuring that the entire consolidation process complies fully with regulatory requirements and accounting standards, maintaining consistency and integrity throughout. When evaluating internal controls, one of the first things we look at is whether segregation of duties is properly implemented and if automated controls are in place. This helps prevent errors and fraudulent activities by ensuring no single individual has control over all aspects of transaction. Next, we identify any weaknesses that might increase the risk of errors or omissions within the processes. Recognizing these gaps is crucial for maintaining accurate and reliable financial data. Based on these findings, we provide recommendations aimed at strengthening the overall control environment, making it more robust and effective. Lastly, we pay close attention to any vulnerabilities that could particularly impact the consolidation and financial reporting processes, since issues here can significantly affect the accuracy of financial statements. Addressing these vulnerabilities helps minimize risk and ensures confidence in financial reporting. During the audit, we identified several key findings that require attention. First, there were notable discrepancies in intercompany reconciliations, which means transactions between related entities are not aligning as they should. Next, we found inconsistencies in consolidation adjustments, suggesting that the process of combining financial data across the group is not fully accurate or consistent. Additionally, delayed documentation was a recurring issue, which can hinder the audit process and affect the timeliness of financial reporting. There were also instances of incomplete disclosure, which impacts the overall transparency of the financial information presented. Taken together, these issues could potentially undermine the reliability of the group's financial statements. It's crucial for management to address these matters promptly to ensure accuracy and maintain stakeholder confidence. When assessing the group financial statements, we carefully reviewed their compliance with the relevant accounting frameworks, like IFRS or GAAP. Overall, the statements align well with these standards, which is a positive sign. However, there are some specific areas that require additional clarification or more detailed disclosure to fully satisfy compliance requirements. This is important because strict adherence to these standards not only ensures transparency, but also enhances the comparability of financial information across different organizations, which is crucial for stakeholders making informed decisions. The audit opinion concludes that the group financial statements provide a fair and accurate view of the company's financial position and performance. This means the information you see is a true reflection of how the group is doing financially. The consolidation process and the overall financial reporting have been carried out in full compliance with established accounting standards, ensuring consistency and transparency. However, the audit did identify some exceptions, issues that need to be addressed to maintain the integrity of the financial reports. Despite these, the audit ultimately affirms that the consolidated financial information is reliable and can be trusted for making informed decisions. To move forward effectively, we recommend strengthening controls over intercompany reconciliations to ensure accuracy and consistency. Improving documentation practices is also crucial, as clear and thorough records support transparency and audit readiness. Enhancing staff training on consolidation procedures will equip the team with the necessary skills and knowledge to handle complexities confidently. Finally, it's important for management to address any issues promptly and set up ongoing monitoring mechanisms. This proactive approach, along with regular review and refinement of consolidation processes, will help maintain accuracy and compliance in all future reporting cycles.